everybody. I'm Ellen Smith. Thank you all for coming. The current credit crunch. I'd like to welcome Jim Hojnacki from Liberty Bank. He's going to be going first. We have Mark Hansel from the SBA Cleveland office, Wendy Bolas from First Merit Akron, and Jamie Walker also from First Merit. Feel free to ask questions. That's what we're here for. I'm going to be also passing out evaluation forms. I'd really appreciate it if you'd fill them out. With no further ado, here's Jim Hojnacki.
Hello, everyone. Can you hear me okay? Yes. Good. All right, let's see if I can find the little pointer. Oh, it's on the podium. Okay, here we go.
Yes, sir.
There's water at the back of the room if anybody would like some.
Well, thanks for having us out tonight. I've had an opportunity to participate in a couple of these forums before. I think they're very informative, and there's been a lot of good interaction over the times I've been involved. Tonight we're here to talk about credit, and some people call it the credit crisis, the credit freeze. Is there a credit freeze? Are banks lending? And but we just wanted to share with you some basic thoughts on it. What I thought I would do is to just cover a couple things real quickly, tell you kind of who I am a little bit and who I work for. We'll cover a little bit about the economy and how that affects the current banking environment and the environment for credit, and how that affects you, because I think that's really what you're here tonight is, to learn is how does the current environment affect me, and can I, fund my business so that I can achieve my dreams and goals. And then we'll have Wendy and Mark and the rest of the team share with you a little bit about their thoughts as well, and probably do a little Q&A, I assume, as well. A little bit about myself. I'm Jim Hojnacki. I'm a Hudson resident here. I've lived here since 2000. Started my career in public accounting, was with Price Waterhouse for about 5 years. Then I got into corporate banking with a couple large banks, and then about 5 years ago had an opportunity to take the entrepreneurial dive and leave a $20 billion bank to join a $56 million bank. And it was really an interesting step for me. I had an opportunity to invest personally in the bank. Myself and 3 others, we came on board as a management team, Bill Valerian, Rich Ebner, and myself, to take the bank forward. And in the last 5 years, we've experienced some growth. We've about tripled our size in the last 5 years. We also went out and raised capital, because one of the things, as you know, you need capital to support your growth. You can't just borrow all the way. We went out and did 2 capital raises and raised about $10 million, and that's allowed us to achieve some of the growth that we've been looking to do. The locations that we have are, we have one on 91 in Twinsburg, right on the Hudson-Twinsburg border. We have an office in Solon on Cruzy Parkway, and then additionally we have an office at the corner of Richmond and Chagrin and Beechwood. The markets that we serve are principally northeastern Ohio, although we have certain segments of our business beyond commercial lending, for example, where we'll do some residential mortgage lending and student lending on a nationwide basis. We are nationally chartered, so it gives us that ability to do that. But as it relates to the commercial lending and commercial activities, that's principally focused in northern Ohio, largely Summit, Portage, Medina, and Cuyahoga counties. Types of lending, we do the traditional full-service banking. On the commercial side, we'll do lines of credit, we'll do term loans, we do SBA loans, owner-occupied buildings, investment properties. We finance equipment, vehicles, things like that for businesses. And then on the consumer side, we do everything from credit cards to installment loans to auto loans to first and second mortgage loans, and those types of products. I don't have to tell you kind of where the economy is right now. There are a lot of questions here. Are we in a recession versus a depression? What are the causes of the underlying problems that have brought us to where we are today? Some would say that it's the subprime crisis. It's And that, how was that brought about? Was it just pure greed and avarice? Was it government policy that influenced, home ownership to go beyond a certain level to the point where maybe people were being given loans that weren't creditworthy? Lots of people have lots of opinions on that. Some might also say, that our economy is subject to regular cyclical fluctuations. You're going to have your periods of growth followed by some periods of slowing as well. The housing market, I think a lot of people will point to that as being a contributor to where we are today. We have experienced some significant declines in the value of homes. I'll give you a personal example. I refinanced my mortgage. I had an adjustable rate mortgage and went to a fixed rate mortgage. And during the time that I did my refinance, they ordered two appraisals, one at the beginning and one at the end, and there was probably about a 20% difference in value between the two appraisals. So, thankfully I didn't have to borrow excessively, and got the deal done. But values are fluctuating. What we found is that in some cases residential values have fallen as much as 15-20%. Probably even more in some markets that are more heavily hit by foreclosures. Certainly I don't think that's the case here in Hudson, although we probably experienced a little bit of a decline. What other types of financial shoes could drop? Some of the areas that are showing some signs of weakness, you'll see the retail environment, for example. Some of the shopping malls, be it a strip center, be it a regional mall, be it other types of retail establishments. If you have a Circuit City or a Linen and Things, or a retailer going out of business, that means lower amounts of rent for the landlord. Additionally, what we're seeing also is that some of those tenants are putting pressure on the landlord to lower rents. We've seen that happen in this type of environment. So it's possible that on the retail side and on the commercial real estate side, that you could have some weakness there. Additionally, people are saying, well, credit card could be the next area that blows up too. You've got all these unsecured credit card loans or student loans or something like that. So, there are certain areas that pose a risk for the economy, and we'll find out. Oil and commodity prices, a lot of people felt that, $140 a barrel oil was a big contributor to some of the slowing that we experienced today. It's definitely put a drag on the economy, and although we've begun to see those prices moderate, from $4 a gallon gas to $2, still though, I don't think you've seen your prices fall to the extent that, the price that gasoline has fallen. I've talked to, for example, folks that sell into the commercial roofs, where you've got oil-based products in the commercial roofing membranes, and they've seen some decline, but not near to the extent that the prices have fallen. But so I think the energy prices have affected us as well, and hopefully if they stay at a moderate level, that will help, because that allows you to have more money in your pocket, whether you're a business or consumer, that you can spend. There are questions about how intertwined our economy is with that of the world economy, and a lot of those things impact our economy today. They say when the U.S. sneezes, other economies get pneumonia. The big question for you though is what's credit availability like, and we'll get to that in just a little bit. Just a couple stats. I pulled these from the U.S. Department of Labor. There's some new data that shows that the economic troubles are at least remaining severe, with non-farm payroll declining sharply in March. They reached their highest level. I believe that there were about 650,000 job losses in the month of March, which was the highest level since the 2001 recession. Factory orders still remain weak. Unemployment rose from 8.1 to 8.5%. Question is where is unemployment going to peak? I really can't say for sure. Maybe some of the other panel experts have an idea. Since the recession began in December 2007, and that's kind of officially when they said it began, 5.1 million jobs have been lost, with almost 2/3 of the decrease occurring in the last 5 months. According to the International Monetary Fund, the world economy is expected to experience lower growth. No big surprise. The 2009 forecast was slashed from 3.9% growth to 3%, which is the weakest level since 2002, and that's the threshold that the IMF considers to be a recession. So that's kind of the backdrop, some of the doom and gloom. Is there a silver lining? Are there some positive things happening? Just recently, yes, I would say. There's a strategist from R.W. Baird, and he noted that what you've had, the falling home values, the drop in mortgage rates have improved housing affordability. Lower energy prices will improve consumer discretionary income, and he believes that that's the first step in the recovery process, and that he expects to stabilize the economy by mid-2009. There's another report that just came out today from Bloomberg, and they said the consumer confidence in the U.S. jumped the most since 2005, and that part of it's a result of the rally in the stock market, which I think the market's up 20+%. I think the Nasdaq's up over 30%. So he says that there's starting to be a shift here where the data is either less bad or starting to improve. So, have we reached the bottom? Maybe, and that's my hope. Will it be a V-shaped recovery where you hit the bottom and then bounce way back up, or will it be more of an L-shaped recovery? It's hard to tell at this point. My guess is that it will likely be the latter. I'm not expecting huge recovery in the short term. How does that affect banking and credit and you? What's happened is, as a result of the erosion in the economy, some job losses, falling values in residential real estate and to some extent commercial real estate, that's caused banks to have some write-offs, and it's eroded their capital bases. It's caused some banks to fail. The IndyMac and Washington Mutual were two large examples of that, where the FDIC had to intervene. The FDIC, the Federal Deposit Insurance Corporation, the entity that insures your deposits up to certain levels, has over 100 banks on its watch list currently. Some banks have had to exit certain lending segments for several reasons. If they're constrained by the amount of capital that they have, like if, for example, if you want to be a well-capitalized bank at 10%, like for me, for example, if I've got 10% in equity, then generally, they don't want you lending more than 100 million. So kind of a 10-to-1 type ratio. Well, if you lose a couple $1 million and you have write-offs of loans, that's going to erode your capital base. So you have to do one of two things. Either you will go out and raise capital, which is pretty expensive right now. If I have to go out and raise equity, like TARP money's not inexpensive. You give up warrants or maybe preferred shares, and then you have to pay probably a 5% coupon on that. That goes up to 9%, and then try to lend it out and make money on it. That's the challenge. You can either do that, or you can downsize your balance sheet and lend less money. And I think that's what's happening in some cases. Is the weaker banks are actually cutting back the amount of lending that they're doing. Some are exiting some segments like construction lending and student lending. Development lending for residential has really been cut back. Delinquencies in that area are probably running about 16% right now. The institutions that have weaker capital positions, like I said, are cutting back on their lending. They're trying to raise capital. Some of them are looking to maybe sell off some of their lines of business. There was a bank just recently that sold off one of its Columbus operations to raise some capital. So you may see more of that in the days ahead. You may see more mergers occurring as some of the weaker institutions need to align themselves with some other banks. In some cases, in one recent example here, there was a large bank that ended up having to arrange for a marriage with an out-of-town bank because of the regulators basically said, we're not going to give you any support. They decided that it wasn't going to happen, so they had to find a merger partner. But the well-capitalized institutions are increasing their market share, and I think you'll also find that community banks like Liberty and First Merit, are in a pretty good capital position, and as a result, it allows you to grow even when the economy is a little slower. So that's the approach that we're taking. The government, like I said, has invested in the preferred shares of large banks and is initiating the purchase of some illiquid securities, basically trying to free up funds at banks so that they can lend. And I think that's the policy objective, and Mark can speak to that a little bit. One other thing that's happened recently is that you may have heard this, is that the FDIC has increased insurance limits. It's gone from 100 to 250, and then in some cases for commercial businesses there's increased levels of support. So trying to instill some confidence in the economy and the banking system so that money can be lent to support legitimate borrowing needs. What's happening to small business credit? What we're seeing is that certain types of credit are less available. Unsecured loans. You'll see credit cards, for example. One way to possibly exit that is to just charge more money, and you'll see interest rates going up into the mid to high 20s in some cases. Certain types of lending, like student loans. Some banks have determined that it's not as profitable as it was before as a result of some policy changes, so they may have exited certain of those types of lending. The credit standards are being tightened. In some cases you might have been able to get by with a 660 credit score before. The requirement may be for a 680 or a 700 on the personal level, or if you're looking at a business loan to guarantee that. Larger capital requirements, maybe instead of 20% down, the bank is looking for 25 or 30% down. So don't be surprised if you're in some cases asked to put down more of a down payment, more capital. So we use the term skin in the game. We want to make sure that we're going to lend a lot of money into a transaction. We want to make sure that the owners of the business have their money right alongside ours. Because I've had those cases. I've had instances where people have handed me the keys and said, what, I can't do it anymore. And the more highly leveraged they are, if there is a loss of business or a loss of a major customer, there's a greater likelihood of bank failure, of company failure, which, you have enough of those, it could lead to bank failure. Some higher rates and fees. Banks have had to kind of reprice a little bit in light of the fact that loan losses have gone up. And if more of your loans are going delinquent, or you're having to write off more loans, then you have to factor that into your pricing. So in some cases you may see some higher rates and fees. And now one of the things that Mark will talk about is some things that are running counter to that may be in your favor, where you might be able to see some reduced fees that, again, make it more economical for you to borrow. As a banker, I'm looking for as many sources of repayment as I possibly can find. The first and primary source of repayment for any loan that I make is cash flow. It's the cash flow of the borrower. And it's cash flow, cash flow, cash flow. It's not the collateral. It's the cash flow that will repay my loan. As an alternative source of repayment, I'm looking for collateral. Then I may be looking for other things like the guarantee of the business owner or some other credit enhancement that can help. So don't be surprised if you see the requirement for additional sources of repayment in the form of maybe, for example, an SBA guarantee. The credit has tightened and it's affected a lot of businesses, and it's certainly hampered the ability of some businesses to grow. But what that means for you is, as you're going out looking to grow your business, look really hard at your business plans. Make sure that you're really comfortable with that plan and that you can deliver on it. And what I recommend that people do is to do a couple sets of forecasts. Give the banker the conservative set, the one that you know that you can really beat. Don't give them the hockey stick projection and then come up way short, because you may find yourself with either a no answer in form of the answer to your request for a loan, or you may end up disappointing, and then the next time that you need the funds to grow, you sort of lose some credibility. So, but I really encourage you to look hard at your business plans and also your capital structures too. You know, how much debt do you have relative to equity? I was talking to one gentleman just prior to the start of the session here, and we talked a little bit about how that a lot of business owners, you know, sometimes there isn't maybe necessarily clear communication between the banker and the customer as to, okay, how much, you know, do I need to fund to this thing, you know, and oftentimes there's maybe a misunderstanding of what the funds are to be used for. So I think there has to be a clear understanding. For example, you know, in a growth business that may end up, maybe you're starting up a business and, you know, you may end up anticipating losing money for 6 or 12 months. Well, you know, the banker isn't really interested in funding losses. The banker may be interested in saying, you know, you build that business, risk your capital, and then get it to the point where it's either, you know, making a little bit of money, breaking even, starting to cash flow. Then we can help you grow to the next level. So sometimes there's a misunderstanding. Some people think, oh, you know, my line of credit can be used to fund my losses. Well, make sure as you're talking to your banker, you have a clear sense of expectations in terms of, you know, what the funds are going to be used for. You need to outline that in your business plans because, you know, I think you'll find that those things are scrutinized. So you got to do a good job of documenting in your business plan, you know, how you're going to repay the loan, how you're going to generate cash flow, and how you can, you know, again, have a good long-term viable entity. You know, what's the outlook for this coming year and how will it affect, you know, the banking environment? You know, the economy may bottom out in the third quarter. You know, I'm kind of expecting rough sledding through 2009. That being said, we're still in a 90% employment situation. You know, unemployment could possibly rise to from 8.5% to maybe 10, 11%. You know, I hope it doesn't, but you know, that shouldn't stop you from running your business, you know, or growing a business, or even starting a business. You're going to see some continued deleveraging of corporate and personal balance sheets. You're going to see, well, you have seen already some U.S. government infusion of capital into banks and the purchase of the liquid securities, and then again, I think that will help instill confidence. You know, I think that the question was, you know, should they have spent all that money to put the money in the banks? I think what it did is it prevented a run on the banks. It created confidence in the system, especially for, you know, one institution dealing with another. There's this whole counterparty risk, and you've got to make sure that the party that you're dealing with on the other side is well capitalized. So I think, you know, the government did a good thing in trying to stave off what I would call you know, a catastrophe. You know, on a worldwide basis, it seems like some actions are being coordinated to provide for growth and infusing liquidity in the system. Mark will talk a lot about the Recovery Act and how that affects businesses like yours, some of the things that the government, the SBA is doing to make it easier for you to obtain credit and to induce lenders like myself to extend credit. And, you know, and I think the thing I want to point out again is, you know, there are a lot of clouds out there. You know, there's a lot of noise. There's some negativity out there in terms of the economic data. But at the same time, you know, there are opportunities. I think there are always opportunities, and we take that view that, you know, as our own institution, from our own standpoint, we're taking the view that, you know, we want to grow even if the economy is in a slower growth mode. And so I think that you can take that same approach as well. It's just a question of going out there every day, doing your blocking and tackling, looking for singles, doubles, and working harder than the next people and taking care of your customer better than anybody else. So those are my basic thoughts, and I'll turn it over to Wendy at this point, and we can answer some questions later. Thanks.
Okay, let me get the presentation up here. All right, now I'm going to make a joke because, you know, I'm blonde, so hopefully I can walk and chew gum, which means I can talk to you all and maneuver this technology. But thank you for having us here this evening, and Jim, you did a great job of talking about the economy, and one of the things that I did first off was, you know, I'm not an economist, so if you want somebody who can come and present about the economy, I'm not your person. So we kind of tailored ours to gee, there are folks in here who probably are starting a small business or thinking about it, and then some already have a business. So we went basic. And, you know, if you're looking to get a loan from your banking partner, you know, what is it that the bank is looking for? And we brought a team of folks tonight. Debbie Lemke over here is our branch manager at the Hudson office. And Jamie Walker is our assistant vice president of business banking. And she works this market here in Hudson. And what is business banking? Well, at First Merit, we work with business owners with annual sales revenues of less than $5 million. Our commercial bankers work with bigger companies, but we like to focus on the folks who are starting out and really need our help. I call them the people that are wearing all the hats, because you're doing everything right now. And then I'm Wendy Bolas. I'm the manager of our business banking department. And a little bit about me, I've been with First Merit, First National for 24 years. I'd like to tell you I started when I was 12, but you all would look at me and know I'm lying. So I won't go there. And it's been a great experience. I've spent time in the retail portion of our bank and time on the business side of the bank, and it's been a great experience. Our bank's lending. Yes, banks are lending. We're out in the marketplace talking to prospects and customers and taking loan applications, and we keep hearing that our competition is doing a similar function. So banks are lending. How do we make loan decisions? We'll talk about that tonight, and actually Jamie will walk you through that, and I'll let her tell you her background, but for a period of time she was in our underwriting department, so I felt, you know, she could bring the best information to the table as far as that. Toxic assets, that's how we got to where we're at least that's what all the news media tells us. But over the weekend I was reading an article in Fortune magazine, and actually it's a quote from Jamie Dimon. He's the CEO of JP Morgan Chase, and he says, banks have also been criticized for improving lending standards. Yes, lending standards have gotten tougher, and that's reasonable. What is not reasonable is to say that the current crisis is in part was a result of bad lending standards, and then to say we should keep the standards the same. So that's that whole definition of insanity, isn't it? To keep doing what you've always done and expect a different result. So you're not interested in, you know, what we all did wrong. You know, we can all take pokes at banks and competitors and whatever. What a bank should be doing is taking prudent risk. And I'm going to take this down to the most simplistic level. Let's just say this side of the room, you all deposit with us at the Wendy Bank, right? This side of the room, you all are small business owners and you're looking to grow your business and you need money. So you come to the Wendy Bank for a loan. Well, the loan I'm making you is their money. And so what I need to be certain of is, when this gentleman comes to me and he needs to withdraw that money because he's making a down payment on a house, and this is really, really simple. So I apologize if I'm insulting you. I need to be able to make sure I still have that money coming back in the door that I can give him his money back. And then you know, it's on a much grander scale, and there are other ways that banks get capital. Yes, that's true. But you know, one of the big measures is our loan to deposit ratio. That's something that's been talked about quite a bit. And we have to take prudent risks with your money as we lend it out. So I think it's time to change it over to Jamie, if you don't mind. I'm just going to have her walk through that. And oh, by the way, ask questions anywhere along the way if you'd like. Please don't hesitate to interrupt us.
Definitely. Everyone can hear me okay? Like Wendy was saying earlier, I've been with First Merit Bank now for 9 years, and most of my career I've been an underwriter. So I'm the one sitting in the back room that you probably never see, deciding whether you're going to get your loan or not. Whether I'm going to, as Wendy was saying, give your deposit money to the people over here. Over the years, what I'm going to talk about is what variables does a bank look at on every single loan before we make a loan decision. We call them the 5 C's of credit, and they're very important. And the first one is their character. When I get a loan application, you know, the business banker in my status now is I get to meet you, I try to ask you lots of questions and really get to know you. But in reality, in an hour, I can't get to know all your personal your deep underlying secrets in an hour. No one's going to tell me everything. So what we have to use is we pull your personal credit bureau. And what we're looking for, I mean, it has a score on there, yes, and we want the highest score that we possibly can get, then you get a lower rate. But what type of things does it really tell us as we're looking at it? The credit report shows me you've already entered into a contract with somebody, whether it's for a credit card or you've gone for a mortgage. Are you paying them back based on the terms that you agreed to when we gave you the money? Is it slow pays? Do you have judgments or liens against your building already, or someone sued you at one point in time? Are you paying your taxes? All these things show up on your credit bureau, whether you're paying your medical bills. Another one is student loans. This is a big one, especially when I was underwriting. When you're a student, if something happened, a lot of times you could call and negotiate, say, I lost my job, can you defer it for a couple months? If you haven't paid on your student loan and you couldn't call and make that appointment or just discuss it with them, then why are you going to call me and say that you can't make your loan payment? It's as easy as that. So that's a big one. And also with student loans, that's a government loan. So if you didn't pay that one, why should we give you another one for opening your business? Also in character, we're looking at what your history is. Do you have management experience in your past that you can have leadership skills with your employees? What's your reputation? Also, do you have experience in the industry of the business that you want to run and start up? If you've always been a contractor doing masonry work, but you want to open a restaurant, do you really understand the ins and outs of that industry? So those are the things we look under for character. The next big one, and Jim hit on this a little bit earlier, was the cash flow. Our main purpose when we loan money out is we want it back. We don't want to go to a liquidation or another repayment source. So the big thing that we look at is the cash flow. Does your business make enough money to pay back the loan that you're requesting? And we'll look at it a couple of different ways. We look as if the business can pay back the loan. We also look at you personally. Do you make enough personal income to pay back your personal debts? And then a lot of small businesses, there's a lot of gray areas between if your business pays your bills or you're personally. So we do it as a global, taking your business income and your personal income and see if you can pay back all of your debt and all for your business and income. The third variable that we always look at is very prudent lending practices to have more than one way out of a loan. Number one is cash flow, but that's when we look at the collateral. And collateral can come in very many different shapes. It could be a truck. It could be real estate. It could be securities that you have used. It cannot be retirement securities, however. We cannot put a lien against your retirement. In the past, since everything has been happening in the market, these collateral, we have only taken we've lowered the percentage of what we will give toward a piece of property or a truck. Originally, when you were buying your residential home, you can find loans out there for 100% of the value. These days, on a commercial, you're definitely not going to get more than 80 to 85%, depending on what bank you're working with. We're going to ask for a larger down payment, more skin in the game from you. The fourth variable is the amount of debt that your balance sheet can handle. We want more equity from you. We want to see that you're going to risk as much as the bank. And the last C, or the last variable that we look at, is more of an external that you as a business owner really don't have all that much control on. What type, in your industry, what's really happening out there? For example, I'm going to use construction because you're hearing about it quite a bit. Residential construction, it's not doing very well right now. And restaurants, that particular industry, 1 out of every 3 restaurants fail within the first year. So we're going to ask that if you want to open a restaurant, that you put more money down. In my own experience, I have a company that makes belts for fighter fighters. They patent the idea, got that all through, but they also have to have it government patent as well. If they couldn't get it through the government, then they can't sell your product. A firefighter is not going to put this belt on, run into a flaming house if they don't know that the government's backing it up. So there's other variables out there that pertains to your industry only that you have to make sure. The other regulating companies like the FDA, things of that nature. So those are the 5 things that we really look at every time we look at a loan. The information that most banking institutions are going to ask for is if you're a current business, we're going to look at your historical numbers for the last three years. Are you making money? Are you showing a profit? And CPAs are really good out there, and they're going to minimize your profits as much as they can so that you don't have to pay the government, which is fine and dandy. But when you go to get a loan and a bank uses that and you're showing losses, is it going to show that you have the wherewithal to pay the bank back for that loan? So it's a double-edged sword. And you got to really work with your CPA and explain what you're trying to do in the future so he can make your tax returns look the way they need to look. And it's all legal. We also, depending on the type of year, we're going to ask for an internal statement. Right now, we're going to ask for a statement for the first quarter of the year. How are you doing? We're also going to ask for a personal financial statement to see if you have a personal wherewithal. If there's a glip in the business, can you put more money in it, or are you going to have to come to the bank for more money in order to move forward? And then we're also going to ask for the last 2 years of your individual tax returns. If you are a startup business, we will ask for a business plan, and Jim touched on this earlier. You really need to put some time and effort into this and really understand what you're putting down on paper and what you're committing to in the next 3 years. Also, something that we're going to ask for is when you, especially with a franchise, we're going to ask you to validate those numbers. How do you know that the rent expense that you're putting down there, did you really go out and do the research? Is that what you're going to pay for that amount of square footage? The insurance, the taxes, all those things you can find out ahead of time. And then we're going to ask why you think you're going to get the revenues that you're putting down. So really put some research into it. There are several types of different debt. We do lines of credit, which is more, this may be a little elementary, but I want to make sure that everyone understands. But a line of credit is usually for short-term debt, something less than 12 months. This is really good for like a manufacturing company who has to buy inventory, and as soon as you sell off the inventory, you pay down the line of credit. It's short-term. You don't want to be out using your line of credit to purchase trucks or equipment that you're going to need longer than 2 or 3 years to pay down. That's not what it's used for. Credit cards are good for overdraft protection on your checking account for like a safety net. Maybe you couldn't sit down one month and reconcile your checking account, so you weren't really sure how much money was in there. It's good to have a safety net. But you don't want to be using credit cards to start up your business, because it's very hard to go into a bank with $100,000 worth of credit card balances and ask to pay them off with a term loan. It's very difficult to get that through sometimes. Credit cards are also good for travel expenses. You're going to pay them off every month. If you're a trucking company, it's good to use them to purchase your gas, things of that nature, because it's an ongoing expense that you're going to pay off every month. Term debt is used for when you're purchasing commercial real estate as well. We will only do usually 80% of the purchase value, depending on what type of collateral it is. The last thing that is really not a bank gives is equity or an investor. We want to see that you're putting some skin in the game, knowing that you're going to put as much on the line as the bank is. And lastly, we put, you want to share? Wendy's going to take over on this little part because she did some research for you.
Talked to some folks at the state of Ohio, and I called some people in the economic development area of the city of Akron, and because one of the things they talked about is what are stimulus funds doing to reach small business owners? And, I could not get clear, definitive answers to that. One of the things I did hear is, and Mark's going to talk to you, where it is really reaching the small business owner is through the SBA programs. And I think, we look at them as a really positive partner to bring in to help folks. But energy and the environment, those are some areas where they are looking to use stimulus funds. In what way? I couldn't tell you that because that wasn't definitive yet, but there is information. I wanted to give you the website for that. They had some lists there, and then ODOT had an article in the Akron Beacon Journal. I didn't put the date there, but they have 120 projects that they are doing, and many of them include stimulus funds, and folks can bid on them. So, I feel bad because I think that the question was really very specific about how is the stimulus fund getting down to the business owner, and it's really not entirely decided upon yet, I think. And so, that's a challenging part for us. I don't know about for you, Jim, but I keep having folks email me information, well, they're doing this program and they're doing this program, but, I don't have a process yet that has been outlined for how we might go about that. The other thing I would tell you is if you are looking to start a business or you want to add another arm to your existing business to grow it, we work a lot of times with the folks over at SCORE, and they do a magnificent job of helping folks put together a business plan. These are people who have, battle scars, if you will, from being business owners. They've worked in the real world, and they're a great resource. The other thing I would tell you is the SBA has a great website that provides you how to make a business plan. They have spreadsheets that you can just fill in there, and I'm sure Mark was probably going to talk about that. But any questions? Yes, sir.
Did your bank get any TARP funds?
We did.
Okay. How much?
We took $126 million,
Okay.
and they were returned last week.
That's good. I was just curious, when the TARP funds were given out, I'm just a little confused by what you're presenting in our role here.
Okay.
When the TARP funds, which was taxpayer money, was given to you at your bank, it was told to us that that money was supposed to help the banks loosen up and lend. Yet I've been reading reports where banks like you didn't loosen up and lend, but you tightened up your lending policy. Now, I may be wrong, but we're kind of in a bad situation here where business is kind of hurting, and where we need capital from banks, and you're making it even harder for us to get a hold of our money, our money that's sitting in here that you had. Help me out here.
Well, I can't talk to you about executive decisions at our bank and why the funds were taken. And but they came with a price. Dividends were to be paid on those. So for the 4 months, I think that we had them, it was reported in the newspaper, we paid $1.7 million in dividends to the U.S. government. And then I can't tell you that our lending standards have really tightened up a lot. No, they haven't. But what I would tell you is, all along, what I would say most bankers would be doing is prudent lending. It doesn't really help someone for us to give them a loan that cannot be repaid. I mean, truly, it doesn't.
That's obvious.
And so, that is the purpose of the lending standards. It really doesn't help you, if we make a loan to you and we take your house as collateral and then all of a sudden it doesn't work, out, and you're saying, hey, I can't do this. So, I don't know, Jim, if you have thoughts, but I would tell you pretty much what I'm doing today is what I did last year and what I did the year before. It's not a lot different in my particular situation.
I guess that's where the rub is, because you just said what you're doing today is what you did before, blah, blah, blah.
Mm-hmm.
But the times, they are changing, and we're in trouble.
Uh-huh.
And you're doing the same thing you did last year, but the economy ain't where it was last year.
Well, I understand that, but I also know that big part of the problem is where banks made loans that couldn't be repaid, those toxic assets. So what
Are those housing loans or business loans?
Both. Most of what you get in the media is the housing crunch, but I think a banker always wants to make a loan that can be repaid. It sets everybody up for success.
Just curious.
Yeah. Yes, sir.
Hopefully access to the state stuff is through the small business development center. Like Troy County has some money for $5,000 grants, small business, but you have to go through the SBDC to get it.
Yes, and I've heard that there's something through the job center too, and I could, yeah, okay.
It's part of the Workforce Investment Act.
Right, yes, absolutely. And there are parameters around that as far as job retention creation.
Do you think with the Ohio Capital Access Program?
We currently do not. Any other questions? Yes, ma'am.
For a beginners to open a business for under healthcare, how can we avail for the stimulus fund?
You could probably, I would tell you the best way that I know that stimulus funds could reach you is through an SBA approved loan. If you're a startup business, that's the most likely method. Now, if you're applying for funds directly from the government, I don't know about that process.
Okay.
Okay?
Now, the government fund, okay?
Uh-huh.
Speaking for your fund, from your bank,
Uh-huh.
in what way can we avail a loan from you?
Oh, we can come out and meet with you?
A secured loan is applicable, secured loan.
Right, a secured loan.
What I'm saying is that if I have the money,
Uh-huh.
I put it in your bank, okay, and I can avail for a loan for that.
Use,
Put my money as a secured loan.
uh-huh.
Supposing I will have secured loan of 20,000 in
Okay.
your bank.
Okay.
How much I can loan out of it?
Out of 20, you're going to put 25,000 on deposit with us, and you want to get
$20,000.
a loan against your 21,000?
I'm sorry.
Is that what you're asking me? How much of
How
that?
much I can loan out of my 50,000?
50?
55.
Okay, I'm sorry, I misheard you. We could lend you 80%, 90% of your cash collateral.
Oh, just the same amount?
What, yeah,
The same amount?
same amount,
50,000?
yes. Okay. Jim, do you have a,
I was just going to make a comment as well. Some of you were inquiring about how can I benefit from some of the stimulus money. One of the things I would encourage you to do is to look and see where some of it's being directed. For example, you see a lot of road work being done, you see a lot of infrastructure work being done. You might be able to sell some products and services to some of the companies in those segments. For example, if there are construction companies out there who are receiving some of these stimulus funds, you might be able to sell products and services to those types of companies. I don't think you're going to get a check from Washington, so I wouldn't encourage you to look for that, in the form of stimulus funds. However, you may well find that there are some companies out there that are the recipient of some of those monies. So I would encourage you to look at some of those industries, explore a little bit, and you may well find that they're growing 20, 30, 40% as a result of some of the stimulus spending, and you may well be able to capitalize on that. So I would encourage you to do that. There was another comment that was raised as well about the funds, from the the TARP monies and so forth. Again, I think, as I said before, in some cases, the government said, listen, we're going to take the largest banks in the country, whether they need it or not, and give them the money. And I'm sure First Merit was one of those banks as well, a well-capitalized bank already. And I think a lot of what they did was, give the money to basically stave off a national, international crisis, really. I think it would have been a crisis of confidence if one or two of the large banks had fallen. For example, Lehman Brothers, fell on the investment banking side. Then the next question was, well, what about a Merrill Lynch? Or, if you had, a couple of the top banks in the country go down, what would that have done? I know that your 401k is probably a 201k like mine is right now, and the stock market was probably down 40% last year. The question is, if they had not taken some of those steps, could we have been worse off? And I think so that was kind of a government policy issue, but, and at the same time, while they encouraged us to take the TARP money, we got the regulators on the other side too. We're regulated by the same group, the Office of the Comptroller of Currency, and they're concerned about the safety and the soundness of the banking system. They come in every 18 months to our institutions, or as frequently as they like, and examine every loan, a large number of the loans on our books. They look at our safety, our practices, how we manage our bank. They look at our capital and our asset quality and our management, our earnings, our liquidity, and that's, it's a constant process. They want to make sure that we're lending on a prudent basis and that we're here for the long term to service the needs of our community. So, I can't speak to why they gave a particular institution TARP money, but I think it was to create confidence in the banking system for the entire country, and so that banks can survive even through a difficult economy and keep on lending. It doesn't mean that we lend to everybody. I'll tell you that I'm looking to make credit-worthy and profitable loans. If they don't meet those criteria, we're not going to make those loans. Now, as Mark will probably point out, there are some instances in which it may be a difficult loan to make. We might not make it apart from something like an SBA guarantee, a credit enhancement, maybe a cosigner. So there are ways to enhance the likelihood of us saying yes. We're not we're not in it to say no. We grew our commercial loan portfolio 30% last year, and I know First Merit is looking to grow as well. And I've got to get out there and make loans, but they've got to be creditworthy and profitable loans. So it's a challenge. If you get people who maybe have lost money for a couple of years in a row, that may present maybe too great a level of risk. It may or may not. I guess you've got to look at the individual circumstances to determine that. Question?
Do either of your banks participate in the Ohio-sponsored Grow Now program?
That's where the state puts funds on deposit with our institution. In our case, we don't. There are some, I don't know if you do as well.
We have in the past. We are not currently, because the premise of the program is the state puts the money on deposit and they take 2% less on the rate of the certificate of deposit, and then we reduce the loan rate. And right now rates are so low on the deposit side that we can't reduce the rate on the certificate of deposit by as much.
And additionally, they require us to collateralize those
Yes,
deposits too, and there are sometimes some issues that are involved with that.
So we have in the past, and I would anticipate that we will again in the future where it makes sense.
At what rate would it make sense?
Well, that's not my decision, but I will tell you, as long as a 2-year CD is less than that, less than what the state will accept, then my guess is that'll be a decision that may not change.
There was another question?
Yeah, I got a question on the stimulus money. You said, for example, selling to somebody that's in construction that's doing these projects. Does the government get involved as far as the product or products that a construction company uses because they've gotten stimulus money? Or maybe I'm not working that way. If somebody bids on a project and it's being funded by the stimulus money, they have, I imagine, certain requirements to meet by the government. Is that correct?
Let's talk to our government expert here. Mark, you want to step up? This would probably be a good transition time.
I suspect that since it's filtered through the state of Ohio,
but again, you know, because it's funneled through the state of Ohio, I think state regulations, whatever there may be there, would apply in that situation. Is that kind of what you were driving at, perhaps?
no, okay, the company gets some money. I want to sell that particular construction company, purple barrel, something else. And I also held to a standard by the government on that particular product because they are using stimulus money on the project.
Right. Oh, gosh. You know, my visceral reaction to that is that I would probably contact Leah Anglin Walsh, and she's the governor's regional rep based in Akron, because I think she would speak more authoritatively on that than I possibly could. No, sorry, I don't. It's okay. Yeah. Oh, well, thanks, Ellen, for inviting me back after January. I doubted that I'd ever come back. But be that as it may, I'd like to recognize Russ Vernon here from SCORE. Russ, you want? Yeah, and Chris Walker as well. And Chris is with an organization called Mature Services. Let me move this down a bit. I find myself at the SBA reaching out more and more these days to various resource partners, because the phone calls that we get at the agency, there are just situations we cannot possibly handle with our products at the SBA. And so thank goodness we have an especially strong SCORE chapter based in Akron. And then we have Mature Services as well. And I bring up Mature Services because I remember getting a call from a fellow who was in his early 60s, and he said, you know, my credit's not great. I'm a welder. I got laid off. I need about $20,000 to, you know, buy a truck and mount the welding equipment there. And I thought, well, you know, maybe Chris has got something. So, you know, I switched him over to Chris, and Chris did bring up the Workforce Development Act, is it? Workforce Investment Act. So even though we may not be able to assist you directly at the SBA, we certainly try to use whatever resources are available to get the job done. I'm here tonight to talk about the stimulus package and how it affects the Small Business Administration. We're a federal agency, we're a relatively small agency, and I represent the Cleveland office. The state of Ohio has 2 SBA offices, one in Cleveland, which serves northern Ohio, and one in Columbus that takes care of central and southern Ohio. And now, what is the Recovery Act as far as the SBA is concerned? Number one, we're offering higher loan guarantees on most of our SBA products, not all of them. We're reducing our loan guarantee fees, and that can save a considerable amount of money. We are going to introduce, although it's not ready yet, a stabilization loan of $35,000 that will provide 100% guarantee to the bank. Again, it's not out yet, and we're waiting patiently for it. We've also sought to revive the secondary market. Oftentimes, banks will sell the guaranteed portions of loans, SBA guaranteed loans that is, into the secondary market, and that market collapsed last fall. We've taken steps to revive that market. There are also tax incentives that are part of the package, extensions on investment tax credits and the like. SBA financial assistance programs, we can help you start a business. Probably about 1/3 of what we do on an annual basis would be considered new business starts. We can help you expand your business or grow it. We do offer a line of credit for export. And the agency has an agency within itself that's dedicated to, I want to say dedicated to disasters, but that doesn't sound right. In response to disasters, they show up and they make loans directly. For example, with the floods in North Dakota of a month ago, SBA would turn out and start underwriting home loans and business loans. Financing options, we provide guarantees. We're not a direct lender, and we can guarantee term loans or revolving lines of credit or both. SBA can guarantee loans for the construction or the acquisition of buildings, acquisition of equipment, term working capital, or if it's on a line, then through a line. We can help the bank help you to buy a business, and we can also guarantee a bank's debt to refinance your business debts. Why do banks use our program? Why do they reach for the SBA guarantee? Frequently, there's a shortfall in collateral, or there's a degree of risk that the bank doesn't wish to undertake. Perhaps there's a longer maturity needed, or leverage, and Jim Hojnacki brought up the notion of capitalization, and capitalization is key, especially when you're thinking about starting a business or even acquiring a business, because when you acquire someone else's business, you're acquiring an intangible, and it's called goodwill. And so you need enough capital to put into the acquisition in order to stay in positive tangible net worth territory. Our primary loan program is our so-called 7A, which is really a section of the law that authorizes the agency to guarantee loans made by banks. There are broad eligibility requirements such as character, and Jamie brought up the notion of character. For us, character usually boils down to lack of an arrest record, if you want to put a fine point on it. Non-passive, we don't do things like apartment house finance, an SBA guaranteed loan, and it has a term of 5 years. There's no balloon. It will be a 5-year amortization with a 5-year term. Our maximum guarantee amount, our net exposure to any one borrower through the 7A program is $1.5 million. So on a $2 million loan, our guarantee is actually 75%, or $1.5 million. Quick notes on the credit crunch. Small business lending down, both at SBA and with non-SBA loans. Our volume's off about 50% from where it was a year ago. A year ago, the Cleveland District Office, and our fiscal year runs October 1 through September 30, so we're 6 months into 2009, and we haven't hit 400 loans yet in the district. So that means maybe we'll do 700, 800 loans this year if we stay on pace and if things don't pick up. Whereas last year, for the year ending September 30, 08, we were at about 1,300 loans in the district. When I say the district, I mean the 28 northern counties of Ohio, stretching from Youngstown to Toledo. There seems to be less demand for loans. The underwriters that I talk to say, the deals just aren't coming through. Plus the issue of higher credit standards that some banks have adopted, expecting more perhaps in equity when we're talking about an acquisition, or in personal credit scores. The 90% guarantee. Historically, ordinarily we would do 75% through our regular 7A program. That is to say, we would provide the bank with a 75% guarantee so that if the loan went bad, we would buy it from the bank and pay 75 cents on the dollar. We've changed that for the regular 7A program, and now we're doing 90% guarantees. So we've elevated the guarantee to reduce the credit risk to 90%. I have to point something out here. That does not apply to a program we have that's called Express. And I want to bring this to your attention because Express is a very important product. It really drives our loan volume. Probably 7 out of 10 SBA loans are done through the Express product. Why is that? Because it's very easy for banks to deal with. It's a cookie cutter approach. Very limited paperwork. Most of the paperwork is done on the bank's own documents, not the SBA documents. The credit decision is made by the banks, not the SBA. So Express really drives our portfolio. And for regular Express, we're still at the 50% guarantee, not at the higher guarantee. There are Express programs called Patriot and Community that do carry the 90% guarantee, but Patriot and Community really don't account for much of our Express lending. So I just want to bring that to your attention. Now, loan fee eliminations. This is something else that the stimulus package has brought. We are absorbing our guarantee fees. That is to say, Congress has appropriated money to the agency to fund the guarantee fees. And our guarantee fees, for example, on a $2 million 7A loan would run you about $54,000. Now, more often than not, the bank will roll the guarantee fee, or would have rolled the guarantee fee, into the loan amount, and we allowed that. But at this stage of the game, with the guarantee fee waiver, we're absorbing that cost, and we have enough funds to carry us through the end of this fiscal year. On the 504 side, I haven't mentioned 504, but let's suppose you wanted to buy a building. And I did have a call from a lady who, this afternoon, who said, well, yeah, we want to buy this building. It's going to run about $600,000. And what can you offer me? And I thought, well, this would be a good 504 project because low down payment, 10%, 50% bank loan, 40% 504 loan subordinated to the bank. And that seemed to be pretty attractive to her, so I referred her on to Bob Flipiak at the Cascade CDC, and we'll see where that goes. But we have reduced our fees under 504 by about 2/3. There's still some small fee there attached to the 504 program, but it's really been reduced. The stabilization loan, as I mentioned to you, this isn't out of the oven yet, but we're expecting it. 100% guarantee on a $35,000 term loan with deferred payments and a reduced rate of interest. And the idea here with the program is to help businesses that are viable, and the bank would make that determination, and the proceeds of the loan would be used to pay existing debt service. Pay existing debt service. So this is like a bridge loan of sorts. We've had a lot of inquiries about it. I wish it were here, but it's not yet. And I would expect it sometime shortly, and I hope it comes through shortly. How do you apply for these loans? Borrowers apply through the banks. Often they call us saying, can I come in and fill out a loan application? The answer to that is no, because we guarantee loans made by banks to eligible small businesses. And banks, they drive the process. They'll take a regular loan application, If it falls outside the credit box, so to speak, but it falls close enough where they're really interested, then they'll probably take it to an internal specialist. First Merit has internal specialists who work on SBA loans all the time. And that person will pick it up and run with it, and they'll get back to you and they'll say, you know, we can do this deal with an SBA guarantee, and if you want to proceed on that basis, we'll do that for you. Other provisions of the Act, and again, this isn't finalized, but we are going to introduce more refinancing in the 504 loan program. Refinance of existing debt has been forbidden under the 504 loan program, but we are going to have some leeway there to refinance existing debt. We do have a microloan program, but and we are going to put more money into that program. Kent Regional Business Alliance is a micro lender with the agency. I've mentioned the new tools to reopen the secondary market. A number of SBA lenders left the market entirely because of collapse. And I'm thinking here of like Business Loan Source out of Houston and Temecula Valley Bank out of California. They were all big SBA lenders. CIT, which is still in the market, diminished the number of SBA loans that they did as a result of the secondary market collapse. And we're hoping that if we can get the secondary market back into action, we'll get more of our lenders involved or re-involved. On the surety bond side, I mean, we've been talking about loan guarantees from the SBA, but we also have a sister guarantee program, but it's for surety bonds. So if you're a contractor and you're having a hard time lining up a bond, performance bond, bid bond, etc., the SBA can guarantee that. And there are a number of insurance companies that participate in that program. For more information, www.sba.gov recovery. That provides a whole lot of information there, including highlights of the stimulus package overall. So with that, yes. Yes, there is interest. It's going to be subsidized, but that's all I know at this point. So I don't know how low it's going to be. Yeah.
And to the bankers, what difference in interest do you charge for a regular loan versus an SBA loan, assuming all qualifications are the same?
I was going to raise a point about one of the SBA sponsored loans, which is the 504 loan program. That's an interesting one because in that particular program, you can get up to 10-year fixed rate money for, I think, rates approaching about 5.2% right now, and somewhere around 5.6 or 5.7 on a 20-year fixed rate basis. So in those instances, with the 504, you can combine that with the lender's funding cost, which is a little bit higher generally, and blend that out at a pretty good rate. You're probably going to find yourself, you know, maybe approaching 6% on a blended basis with a 504 loan, with, as Mark said, possibly something like a 10% down payment on that. As far as regular 7A loans, there are some restrictions placed on us by the SBA. Mark, maybe you can just kind of highlight that. Yeah, normally we impose ceilings. We don't tell the bank what to charge a customer, but if a loan has maturity 7 years or longer, the ceiling is 2 3/4 over prime. And if it's under 7 years, it's 2 1/4 over prime. However, there is an exception under Express, and banks can charge higher interest rates under Express.
So if it were not an SBA loan, would you be charging less interest or more?
I guess it just depends on the individual circumstances. How much you're lending, what the collateral support is, what the cash flow is. So I can't say there's a hard and fast. You know, generally, the fact that SBA is there is an indication that we needed some sort of additional credit enhancement to do the deal. If, you know, and I'm not sure what percentage of the total loans out there are SBA, you know, backed loans. It's probably a couple percent in terms of the total loans that are done, you know, nationwide or something like that. But it certainly does help us, and it would be factored into a pricing decision. You know, if you were looking at unsecured loans today, you know, one, you're going to find that some banks aren't even doing them. Two, it would probably be approaching credit card type rates. So, you know, the fact that you've got, you know, collateral backing and or credit enhancement from an SBA, maybe on a partially, you know, collateralized loan, because there are instances where we will look at a loan that that may have some collateral shortfall, and so I think we would, you know, factor into our pricing the guarantee the SBA would help.
Are
Yes.
the majority of the loans only floating rate loans?
No, I mean, from the SBA perspective, we'll let the bank fix or float the rate. So it's a bank decision, so long as they stay under the interest rate ceilings.
And oftentimes we generally quote both ways, both with a floating rate option and a fixed rate option. You're going to generally find that the floating rate option is a little lower today, probably, you know, maybe a half to 3/4 of a point lower than the fixed rate generally, you know, for something like a 5-year term.
We quote both. Most often, the borrower tends to lean toward a fixed rate.
Other questions? Yes, sir.
What kind of projects or businesses are would qualify for the 501 projects that you're referring to?
Well, the 504?
Yeah, 504. I'm sorry.
Can you repeat the question, Mark?
Oh, very good. What projects would qualify under 504? And 504 is a good product for acquiring fixed assets, and 9 times out of 10 that means you're buying a building or you're buying land and you're going to construct a building. I mean, sometimes there are just equipment only deals, but you know, the run-of-the-mill 504 is usually a real estate transaction. And is that what you were driving at there?
Well, no, I was just curious.
Oh, yeah, but I mean, under the 7A side, we're a little more flexible in what we can do. I mean, you know, 504 as a loan product probably accounts for only about 10% of our volume nationwide, because under 7A, I mean, we can refinance debt, we can term out debt, we can do a lot of things that we can't under 504. But 504 is kind of a targeted product. I mean, it was put there for a reason. So, other questions? Very good. Thank you.
Thank you.